Welcome to another live stream. My name is Ansel Lindner. This is Bitcoin and Markets and Rogue Macro on the screen right there. You're seeing the Substack for Rogue Macro. I'm starting to put some of my older macro related things onto Rogue Macro, the Substack. So hopefully this starts to catch on and broaden out this this brand. So okay, what I wanted to do today was take a quick look at the charts and then react to Brett Johnson, famous Brent Johnson, Santiago Capital. And he is talking about gold in one of his latest videos. So I wanted to take a look at that. Let's take a look at the charts. Here is gold hitting barely a new all-time high today by $1. So Friday was 4,380, and today we hit 4,381. So an all-time high by one stinking dollar. But what's going on here with gold? I think this is one of the big question marks out there in a lot of people's minds. I mean, just the sheer size of what's going on here with gold. So gold is a $20 trillion, or was a $20 trillion asset, and now it's a $30 trillion asset. So what in the world can make something that's a $20 trillion asset rapidly grow over just a few weeks? If we go to the weekly chart, and we zoom out here, let's see. So from August 18th to today, it's just straight up, right? What can make a $20 trillion asset behave like that? So we've been asking this question. I talked to Nick Bhatia last week. He was on the space. I do spaces for the BitcoinTreasuries.net X handle. And I had Nick Bhatia on last week, and we talked about everything, macro, Bitcoin, all that. And then I watched one of his updates from his channel later on, and it was about repo market. It was about some of the SOFR spreads and these type of things, and like very nuanced arguments about what could be happening deep in the financial system. So he gave us a little bit of info there. Then on Friday, my conclusion on the stream was, there's nobody really knows what's going on here. We do know that it's not China stacking gold, and we'll get to this with Brent as well. He has the same conclusion. It's something breaking in the financial system. It's not some sort of monetary question where people are dumping dollars, dumping treasuries for gold or anything like that. This is some deep concern in the financial system. And so we're going to listen to Brent and see what he has to say. But before that, let's zoom through some of these charts. We have Bitcoin trying to stay in this parallel channel that we have been in for the entire quote unquote bull market. Some people, including myself, think there's a possibility that the bull market hasn't really even started. When you look at some of the on-chain metrics, or if you look at things like short-term hodler levels or long-term hodler levels, these are levels where Bitcoins have moved, and then that becomes the basis for that. And then you can track like people that have held over 90 days, under 90 days, those types of things, those type of metrics. You can track those, and we are not in bubble territory whatsoever on pretty much any metric in Bitcoin. Even on the charts, we're not overheated on any daily, weekly, monthly time frame. No time frames are overheated at all. So Bitcoin, are we even in a bull market? I think we are, but we are in the early stages still. I put out this tweet a little while ago saying, if we stay in this channel, 200,000 is still possible by, let me make this bigger for Telegram. Sorry, guys. 200,000 is still possible by the end of the year. It would be at the top of this channel. It would be a huge move. It would be a big story, kind of like what gold's move has been. Big move, huge story, but it's possible inside this channel still. So that's what I'm looking at for gold or for Bitcoin. One thing I did notice as well, if we go here to treasuries, this is a 3-month treasury, and it has started moving down. You can see over the last 2 trading days, let's go down to daily. and we're going to do, well, you can see these candles here. These last 3 candles are down. And if we just go to the line, because we get rid of some of these different, I think this is just the data being messed with. So if we take that out and we just look at the closes, you can see that it has been diving. This is a 3-month yield. It never went back into the Fed funds futures, and now it's starting to head down again. So we have 10 days until the FOMC, until the Fed moves. I'm going to be watching this very closely and see where this levels out again. So if you look before the last cut, we started leveling out right there, just slightly below the new target range. We'll see if that happens again. If it drops dramatically, let's say this drops, it's at 388 right now. Let's say this drops down to 350. I think the Fed will have a 50 basis point cut. They won't surprise the market. They will do what the market is pricing in. So that's how I'm looking at that. All right, let's jump over to Santiago Capital. You guys should go and subscribe to this channel and at least give the video a like. Brent Johnson Milkshakes Pod. But let me check the chat. Okay, good. We're getting some... we're getting connectivity now with YouTube. Like I said, I'm dual streaming on YouTube on 2 different channels and also on Telegram. Let me see if there's any comments from Telegram. No, okay. All right, I think we're dialed in. Let's go.
Dollars this week before ultimately pulling back on Friday morning, and it was around $4,000.
Thumbs up for volume.
$50, which is a fantastic year-to-date number for gold. And I've been getting a lot of calls and emails about what I think about gold here, so I thought we'd just do a little update on that. But before we get into it, I'm going to say that I think about gold much differently than many people. I try to stay as rational as possible about it. And the reason I laugh is because a lot of people get irrational, in my opinion, when talking about gold. And the funny thing is, they get irrational for a very rational reason, is because when gold is at $4,200, that is telling you something is either politically, economically, geopolitically, socially, something is wrong in the world, is up 50% for the year and at an all-time high. That is gold raising its hand and saying, hey, check me out because all is not well.
Exactly. And that's what we've been talking about for the last week. And what's interesting as well is it will eventually lead to Bitcoin rising. So this has happened several times over the last 2 years. Gold will take off, almost the exact top that gold has. Bitcoin then starts its big move. So most likely what's going to happen when gold finds its blow off top, Bitcoin will then take over and move perhaps up to 200,000, like I said, by the end of the year is possible. It is in the realm of possibility. If a $20 trillion asset can move to 30 trillion, a $2 trillion asset can move to a $3 trillion asset, or a 4 trillion. It's not as big of a lift for Bitcoin to do that. And then he was talking there about being rational, irrational in talking about gold. Absolutely. I mean, that's what Brent is very just logical and straightforward. And when he says something, he'll say like, it's more likely to be this way. This is what's happening. It's more likely to have this sort of outcome because of XYZ. But he never says it cannot be another way. Right. And he will get hounded on. So, and I mean, he is very pro gold. If you listen to this whole episode, he is very pro gold, recommending people up to a 25% allocation of your portfolio into gold. Very pro gold, but he's not pure enough for the gold bugs. Not pure enough. He dares to say one or two things negative about gold, and the gold bugs hound you. Been dealing with the Peter Schiffs of the world forever. Okay, let's continue.
And as a result of to kind of be irrational, right? If gold is saying, hey, you better take a look, you should better take a look. But it's also the time we need to, as much as you can, tamper down those emotions. So that's what we're going to try to do today, and we're going to try to just kind of walk through this in a logical manner. And I'm just going to tell you how I think about gold. You guys might think about it differently to my portfolio and my clients' portfolios. And as a result, it perhaps plays a different me and for my clients than it does for you. I think of gold as a wealth preservation tool.
Okay, so this, we can skip this part.
How do we avoid the big drawdowns and participate in the upside? And this is what that portfolio looks like from 1970. Listen, it's a few years old. I probably need to update this, but over that 50 years, they only lost money. This portfolio only lost money 6 times, and the most it ever lost was 12%, and that was during a global financial crisis. Other than that, it ever lost was 4%, and as a result, is because, and part of the reason I kind of started using this as a base case is because after 2008, I decided that IMF, Bloomberg, and JP Morgan, that's wrong for this slide. I'm not sure why that's on there. But after 2008, because I was doing this in 2008, I decided that you could no longer take all scenarios off the table. You literally had to be prepared for everything. And being prepared for everything ranged from a full recovery where everything was totally fine on one end and a total monetary system collapse on the other. And we kind of modeled out 4 different asset classes and how we thought they might react in these different.
You're welcome, Casso. Thank you. Let me check and see if there's any comments over here on Telegram. All right.
Different economic scenarios. If you muddle through, maybe they all just kind of go up and down a little bit and nothing, really stands out. If we were to get into some kind of a deflationary scenario, then, equities and real estate probably don't do very well. Gold might do well, but it might go down initially, but then do really well. Bonds would probably do well in a deflationary scenario. In some kind of an inflationary recession or an inflationary depression, then you would expect real estate would probably do well, although it somewhat depends on what interest rates are doing. Bonds would obviously not do well. You'd want to stay away from them. Equities and gold would probably do fantastic in that scenario, and maybe equities would. In some kind of
yeah, so this is a good point. He's going through the different types of scenarios here, and his 25-25 portfolio, like 4 chunks, 25% each. And what I think, though, is that there is a very low chance of an inflationary recession where we have a runaway like inflation, 1970s style, great inflation, stagnation with inflation. We're not going to get anything like that. The overarching or overriding influence here is a deflationary pressure. All bubbles burst. And in this system that's built off of credit-based money, a bubble looks like that credit bubble bursting. And what happens? The amount of credit will go down, and that is literal deflation. That is the overarching pressure, okay? And the way that the economy is staving that off is they're trying to kick the can down the road. They're trying to extend and pretend, but they cannot solve the issue. So what would solve the issue is creative destruction, wiping away bad debts, malinvestments, and starting anew, right? But since everything is built on credit, that means everything has to crash to zero, and they are unwilling to legally allow that. So we see all these facilities from the Federal Reserve. We see TARP. We see different fiscal bailouts. And they change the rules in order to extend and pretend. Now, are we towards the end of that? Because eventually that can't go on like that forever, but it can go on like that for a very long time. All else equal, that could go on for another 50 years, even 100 years. It really could. But usually what happens is some sort of war breaks out, or we have some external thing, or we have even an internal political revolution and like a fourth turning type event, and that will force the change. Okay, so that's what we're kind of that's what how I'm viewing this. Overriding pressure is deflationary, but they can't extend and pretend, change the rules. They can extend and pretend, change the rules, and live another day. But eventually that will stop. And like he says, you have to have all of these scenarios. He has monetary system collapse on this slide, in this pane right here, this section. I don't think we can have a full recovery. We can muddle through. That's a good one. Deflationary recession. Recession with sovereign defaults, okay. Monetary system collapse, but this inflationary recession one over here is not on the table. Anyway, those are just some tangents.
Recession with sovereign defaults, and this is on Europe in the early 2010s, is you could see real estate fall kind of up or down, stocks kind of a lot, but gold, and again in euro terms, perhaps did pretty well in part of it. Or if you system collapse, and obviously you want to be out of all financial assets and you want to hold something like gold, real estate actually would probably do well in a monetary system collapse, although the currency value of it would obviously
land would do well.
Fall. But again, it was kind of thinking through all these different scenarios. How can we be prepared for all these different scenarios? And the permanent portfolio, or at least using the permanent portfolio as a roadmap, was a good way to address it.
Castle, you say that fiat is anti-free markets. It cannot handle deflation. On a personal Bitcoin standard, it's the opposite. Yes. So, well, I don't know, Castle, how long you've been watching my stuff. I've seen you before, but I don't believe that we have fiat money right now. We have credit-based money. It's different. It acts differently. So, yes, fiat is 100% anti-free markets, but credit-based money is not completely anti-free market. It actually has a supply and demand dynamic that causes supply and demand to shift around, that the Fed can't manipulate and the government can't manipulate. They can try to paper it over there. They can try to change the rules, but they can't ever get rid of it, because to get rid of what the market is trying to do is just makes things worse. It's just like in any sort of political thing. If you try to hide the truth, the Streisand effect will snowball that, and it'll be a bigger deal than it ever would have been. Anything, some problem with your health, and you try to deny it, and you try to just move on with your life, maybe make a few different changes, yada, yada, yada. And, you've been watching since World Crypto Network. That's awesome, man. So yeah, you can try to hide things, but eventually you pretty much just make things worse. So the Fed and the federal government, they can try to hide this credit bubble, and they can try to hide the deflation, but they just make it worse. They push us more down the diminishing returns scale, right? And they make it worse. That's why we can't grow ourselves out. That's why full recovery on this slide, full recovery is not possible. Neither is inflationary recession. So we can cut these things off. Muddle through would be more of like very low growth, low inflation. That's possible. Deflationary recession is absolutely possible. That's what we're going towards. Recession and sovereign defaults. This is possible because of like sovereigns, Japan or some other sovereigns out there the UK, Canada even, could have some sort of sovereign defaults. And the US probably won't, at least in the foreseeable future. I'm talking decades down the road. But it is possible perhaps in some other dirtier shirts out there. The US and the US dollar are the cleanest dirty shirt. And so they will have sovereign defaults later, or the US will have sovereign defaults later than these other ones. So that's possible too. But I don't see that in the very near term. That might be 5-10 years or more. In the very near term, the real option, I think, is muddle through or deflationary recession. Muddle through or deflationary recession. So, yeah. All right.
So that's how I think about gold. Now, this is kind of also, when I was thinking about these different asset classes, kind of came up with the whole milkshake concept. And again, the whole milkshake theory was my belief that because of all the debt in the world, we would get into a situation where the dollar would rise versus other fiat currencies, and that would have impact on other asset classes. And the impact on the other asset classes would be that bonds would fall, interest rates would rise, and U.S. equities would rise as well. And if you look at this chart from when I first said that, that's basically what happened. Now, what didn't happen, what I thought would happen by 2024 and didn't, is I thought we would have a currency crisis. We got very close in 2022, but ultimately it didn't happen. Europe or England went into a very short-term crisis. Japan had a lot of trouble with both their sovereign bond and currency market.
So one of the differences here between Brent and myself is that my analysis, I place us on an evolutionary path. All right. And evolution is not in one direction. A lot of people think that, they're progressives, they're economic progressives, and they think that we're getting better and better and better. So I would put, respectfully though, I would put Jeff Schneider in this economic progressive camp because he thinks that money has continued to get better. We had gold and silver coins, then we had banking, then we had book money, then we had the credit money that we have now, the Eurodollar. And every time we're stepping forward in this progressive economic path towards better money. I don't think that's how it works. So I nest it in an evolutionary path. So gold and silver was the most saleable good. Well, why did gold lose? So Bitcoiners, I got mustache tickling my nose. Okay, so why did gold lose to the credit-based money? Most inflationistas can't answer that. Most Bitcoiners can't answer that either, because they'll say, oh, the government forced it on us. Don't you know 6102? Okay, well, the government is forcing dollars on us today. How can we ever expect a Bitcoin standard to happen? If the government can beat gold, the government can easily beat Bitcoin. That's what they're saying, but then they won't make that logical connection. So the way I get around this problem is I say, no, the market chose credit-based money. Why did it choose credit-based money? Because we were at a very unique period in time. After World War II, America was 50% of the free world's economy. If you include the entire world, like the Soviet and China and stuff like that, then we get down, it's like 30, 35, maybe 40% the US economy was. But we were definitely the leaders of the free world. We set up the UN. We set up the WTO. We set up the World Bank and the World Court. We set up the IMF. We set up all these international bodies to create this world, this globalized world that we see, led by the US, not as a conqueror, but as a supportive function. The US was so dominant after World War II, we could have taken over large swaths of the world. But we didn't. We actually led it from a free market perspective. Okay, on top of that, so you have this benevolent hegemon. On top of that, we had a lot of technology coming out. We had air travel. We had nuclear energy. We had different electromagnetic stuff from radio, TV, computers, transistors. These things were just getting going. Okay, so we had this confluence of a benevolent hegemon that had tons of money to lend, and you had mega growth opportunities. So people picked credit-based money because it was more elastic. They could lend it out. They could create it out of a loan at a bank, pump up the money supply, but that will lead to a lot of growth, hyper productivity. Now that has tailed off, and we're at the end of this giant credit 75-year credit bubble experiment, and we're starting to have diminishing returns. In many places, it's close to, it's below one. Okay, so $1 in new credit does not produce $1 of growth, even to service that credit. Okay, so some places are like that already, but the world itself as a whole is approaching that right now. So that's where we're at. And in that, when credit starts to not be productive, the evolution will push us back towards things that don't have counterparty risk. So gold and Bitcoin. Then it becomes a gold and Bitcoin competition. And Bitcoin has superior features. And so Bitcoin will be selected eventually as the next thing, the next evolution. So you could say it's a de-evolution. We had gold and silver, then we evolved into credit-based money because of the very specific circumstances after World War II. Those days are over. The environment is changing, and we're going to evolve again. Now, in the absence of Bitcoin, we would evolve back to a gold standard. But with Bitcoin in the picture, we're going to evolve into a Bitcoin standard eventually. Now, it could also be that we have a dual metallic gold and Bitcoin standard, something like that in the meantime. But that's what we're evolving towards. So all of that to say, that long tangent is to sum up how my analysis is different than Brent's. Brent's, I agree with what he's saying here. In these certain circumstances, in the dollar milkshake era, which I think is a period of time that we happen to be in right now, post GFC, post Great Financial Crisis, for the several months, several years, or even several decades after the Great Financial Crisis, as we're evolving, the market is going to look a lot like what he's saying here. So I agree. He's describing something that I agree with, but I nest it within a broader thesis. All right. Let's continue.
State collapse really accelerated during 2022, but ultimately the Fed turned course. The dollar has fallen since that time, but it's still up.
Okay, Casso. The book The Price of Tomorrow by Jeff Booth explains the fiat system and terms like deflation perfectly. I'd recommend reading it. Yes, sir. I have read it. And I interviewed him too when I was hosting with CK over there on FedWatch for Bitcoin Magazine several years ago. He has a different type of deflation than I have. So he thinks deflation is from productivity gains. So he thinks that there's going to be monetary inflation, but that the gains that we're going to get from AI or we're going to get from anything, any new technology, are going to be so far outpace that monetary expansion that it will look like price declines. So it's not actually deflation that he's talking about. He's talking about productivity gains, and I simply do not believe that. Look at the demographic situation. All right, that's one of the keys to everything here. The demographic situation. What happens when you have one thing? We benefited not just on the specific technological benevolent hegemon, all of that after World War II. We also benefited from a demographic dividend. Infant mortality plummeted. Population exploded. We had more inventors, more scientists, more workers, more of everything. In a demographic decline, it's not just the fact that you don't have any workers. That's your least of your worries. You don't have anybody to buy stuff. And AI isn't going to buy stuff from you. So as people get older, so first we're going to age, then we're going to shrink in population. 75-year-olds don't buy as much as 35-year-olds with a family. So first we're going to get old, we're going to stop buying stuff. Then the population is actually going to shrink. And there's not going to be any consumers. There's not going to be any scientists. There's not going to be any engineers. Okay? So you have to have all of these things to keep a technological race going. And also, guess what else? Technology is dependent on credit, R&D, et cetera, et cetera. And so you have this diminishing returns on credit, declining population. That is a recipe not for a deflationary takeoff like Jeff Booth says. It's setting the stage for a deflationary collapse of credit. In periods like this, actually, we can lose technology. So I'm not a believer really at all in AI. I think that it's producing a lot more noise, and it's costing us money to sift through and find signal. The internet does a lot of that as well. But I don't believe in this great productivity leap from AI. I just don't believe in it at this point. They don't make money. They're all running in the red. And companies like OpenAI, they do not even have a pathway to profitability. So it's just a big fat waste of money. Now, things like quantum computing, I just wrote a piece on that. You can check out that over on Rogue. Let me share this tab. Did I put it over here? If I didn't, I'm going to do that. Oh, yeah, case against quantum computing. So I go through all of these things. Breakthroughs are constantly walked back. Go through detail out all of these different things that they constantly walk back. They can't even pick a qubit. Here's all the different types of qubits people are experimenting with. Pick one. If you know what's going on at the quantum level and you think you can control this stuff, pick a qubit, all right, and do it, and then come through with some real results. Bubble dynamics, it's all bubble, even though these companies don't make anything actually. And yeah, then critique of quantum mechanics in general, quoting from the physicists themselves. So this isn't necessarily me. This is what the physicists are saying about quantum mechanics. And so, yeah, I'm not a big believer in AI. I'm not a big believer in quantum computing. I don't see where this hyper growth is going to come from, especially when you mix that with a demographic collapse. So, all right, let's continue.
8 or 9% from when I first said it. So the asset class reactions have played out, just not to the extreme that I thought. But now we've seen gold just have a heck of a year this year, even though equities have had a really good year as well. Bonds have kind of gone sideways this year. But the point is that even though the crisis that I expected to happen didn't come to be, the framework was very helpful in allocating assets and understanding what was going on. And gold is a big part of that. Now, the other thing, and I know many of you have heard me say this 100 times, but in case there's anybody new, I'm going to say this again, is the milkshake has never been anti-gold. Gold has always been a big part of it. And, there's numerous interviews where I've explained this in detail.
Yeah, he's never been anti-gold. Everything he said has been pretty much accurate over the last, say, 5 to 10 years. But he's arguing with like people that are just so dogmatic in their beliefs, they cannot bring themselves to see the signal that he's giving out.
And I think in the very first interview, I said gold will be the ultimate winner and gold will win in the end. But that did not mean that you needed to wait around for several years and own gold. I was very clear that everybody should own gold. What I mean when I say gold wins in the end, it just means it's the last one standing. But in the meantime, gold could do very well. Gold, and to me, nothing is more bullish for gold than the dollar going higher, because the dollar going higher actually wrecks the entire system. Part of the reason that gold is doing so well this year or over the last 2 years is because dollar did so much damage to the system in 2022. And this is the reaction to all that damage. But the point is that, I don't want anybody to think when I talk about the dollar, it is not anti-gold. Again, there's nothing more bullish for gold than a strong dollar. And I made it.
Yeah, I mean, that's a great point. People don't get it. Okay, the dollar getting stronger is bad because, well, one thing I said, the way I put it in the past, is that the Fed losing is deflation. That's the Fed losing. People think the Fed losing is high inflation. Okay, I guess hyperinflation would also be the Fed losing, but we're not going to see hyperinflation. The Fed losing is deflation. So if the dollar rises, it squeezes the rest of the world. They have a lot of dollar-denominated debt, trillions and trillions, in the double-digit trillions, okay? And as the dollar goes higher, it's harder for them to pay that debt. It squeezes them. It's bad for the global economy. And then what he's saying there is that's bad for the dollar system. Now, he says that eventually gold will win. He would probably entertain, because he's an intellectually honest person, he'll probably entertain that Bitcoin could win as well. I would say that a possibility he's discounting is the evolution of the dollar itself. So the dollar has changed 5 or 6 times in history, from a silver standard to a gold and silver standard to a different gold and silver standard to a pure gold standard to a different gold standard, and then to no gold standard. It can change again. The dollar can change again. And it will. I mean, if you were the powers that be and you had some choice where either the dollar completely crumbles and goes away, or you back it with something that you have in your reserves, whether that be gold or this Bitcoin reserve that they just added another, I think, 100,000 Bitcoins through asset forfeiture in a legal case. So, like, you have these reserves. Would you watch the dollar collapse, or would you back it with something? You're going to back it with something. So the dollar can change. Now, is that gold winning? Yes. Is that Bitcoin winning? Yes. Is that the dollar losing? No. All right, let's continue. Yeah, Casso, I'm fine. I'm fine with different opinions, man. I think I obviously know I am in the vast minority on both of those views that I just said about AI and quantum computing. I know, but show me the money, show me the scoreboard, show me a path to profitability for these people.
Very clear in my very first presentation on this that, my gold thesis has never changed. I'm not going to go over this in detail. I've done this before. But, I said at the time, the gold will go to at least $5,000 and probably a lot higher than that. We're not too far away from that at all. So again, when if I'm predicting that the gold is going to $5,000, that's obviously not bearish. I think gold was, $1,200 or $1,300 at the time. And again, I'm not going to go into detail on this, but part of the reason that gold up, I thought, was driven by foreign buying. And since the dollar went up in 2022 and kind of caused all this chaos that happened in 2022, foreign buying has been the main driver for gold going higher. And that brings us to this. And we touched on this chart a couple weeks ago, and I wanted to bring it back up again because I'm going to show you a couple other charts that I also think are important. Now, this shows that gold is rising as a percent of reserves and that U.S. Treasuries are falling as a percent of reserves. Now, part of the reason, there's a couple things that isn't explained really well on this chart. One of them is the part of the reason that the U.S. Treasuries are falling as a percent of reserves is because that figure is based on the price of bonds, and the price of bonds has fallen as interest rates have risen. The other thing is part of the reason that these lines are converging is because the reserve holdings of gold are based on price as well. And the gold price has gone up a lot. And so that is, now, this is not to say that they're not buying gold and they're not selling treasuries. I'm not saying that's not happening. That is happening at the margin. And I would argue the central banks are preferring to buy gold versus treasuries right now. But that doesn't mean that this is all based on actual holdings. It's based on price. But the other thing is, I just want to point this out, that the major foreign holders of U.S. Treasuries has never been higher than it is today. This is billions of U.S. dollars. This is foreign holders of U.S. Treasuries. So it has never been higher than it is today. Now, the other thing, this is also based on price, because the Treasury tick data that gets published is based on market value. And this shows that it keeps going up. And this is despite the price of Treasuries falling. So the point is there still have been buyers of U.S. Treasuries. Now, I would argue that if interest rates hadn't been going down, and if the world was a little bit safer place and there wasn't as much geopolitical uncertainty, they'd probably be buying more Treasuries and less gold. So from that perspective, and again, that was part of the milkshake. The milkshake said interest rates would rise, bonds would kind of get rejected, and as a result, gold would be bought, equities would be bought, et cetera, et cetera. So
yeah, I will add that they don't want to buy gold instead of treasuries. Treasuries are much more liquid. They can be rehypothecated, ad infinitum. They're much more useful to these holders of reserves, these U.S. Treasuries, than gold is. Gold is a rock sitting in a vault somewhere. You can rehypothecate it, but it's not nearly as easy as rehypothecating U.S. Treasuries. So they really don't want to buy gold, but why are they doing it then? Because of the risk. And all it takes, like last week, one of the things I said is, it was when I was talking to Nick Bhatia, that if you just change, they have these large asset allocators. They have these formulas that will dictate their allocations to different things. And if if they view that risk is going up, then their formula will create a rebalancing in their portfolio, right? So if you have a risk that's going higher, whether it's geopolitical risk, whether it's economic risk, whether it's tariff risk, whatever, war, okay, your calculation will adjust on the fly. And maybe you'll buy more gold than you will buying treasuries. That could also have happened. So they want to own treasuries. They don't want to own gold, really, because it's not nearly as useful. And that's one of the hurdles that Bitcoin has as well. Bitcoin has this problem. Hey, Casso. Yeah, Gabriel is in the Telegram regularly. You should join the Telegram if you're not in there. Link should be below. Yeah, so this is they don't want to buy gold. They want to buy treasuries because they're more liquid. And that is a hurdle for Bitcoin as well. And the way to move towards gold adoption and Bitcoin adoption is exactly this reason. Risks going up, growth potential going down. And you want to move away from counterparty risk. That is the way that Bitcoin will be adopted. And that's what's happening with gold now too. For years, I've been predicting higher Bitcoin, higher gold, higher stocks, and lower bonds. Of course, we had the Fed raising rates and we had the market pricing that in a little bit. But they couldn't force the 10-year even up into the federal funds range. If we go to the 10-year, let's go back to the charts. If we go to the 10-year and we zoom out, you can see the Fed, and I just go to regular. The Fed tried to raise rates here, right? They were raising rates, but they tried to force rates higher across the spectrum, across the curve. They couldn't do it. Look at the 10-year. It disobeyed. It rejected these higher rates. They could not force the 10-year up anymore. And then they're just following it down. If we instead look at the 2-year, the 2-year wouldn't even obey. It kind of got close, but it never got up here. Remember, this is overnight rate. And this is a 2-year. This inversion, big time inversion, even on a 2-year. What about the 1-year? That probably got in there. Yeah, they were able to do it with the 1-year, but then it started disobeying. And you could tell by this, when this didn't come back in to the Fed funds, you knew something was wrong. You knew that it was starting to go down and they were going to be cutting very soon. All right. So that's that.
But I think we're seeing that, but I just want to point this out that it's not like the whole world is completely rejecting treasuries at this point. That could happen, but as of right now, it's not. The other thing is I wanted to share these charts. I just found these charts today, and they're great charts. And I knew this was the case, but I just hadn't gone through the process of calculating it. But basically what it shows is that world FX reserves and being held in gold, part of the reason is, again, a lot of the reason that the gold as a percent of reserves is rising is because of the price. It's not so much because central banks are out there buying tons and tons and tons of gold. They are buying gold and they are buying tons of it, but it's not like the whole world has just completely dumped treasuries and started to go buy gold. And that's why gold reserves have risen so much. A lot of it is tied to the price. And you can see that even better on this chart. This chart shows, and now the red line, this was what would happen if going back to 2009, if central banks had not purchased any new gold as reserves and the price did what it has done, that would be the red line. The blue line is the actual line, which shows the price plus the additional purchases of gold reserves. The gold line is what would happen if there had been no appreciation in the price. In other words, it's actually fallen. The actual holdings of gold ounces has fallen since 2009, but it's the price rising which makes the percent of reserves rise. Now,
this is a damning chart, and the wow chart, when I watched this video for the first time, I was like, holy crap, look at that. This settles the whole debate. It's not because they're buying gold. Their holdings of gold are this bottom line here. That's their holdings of gold. This is the value of the holdings of their gold. Okay, it's not because they're buying gold that this is happening. Something else is going on. These are world FX reserves, so these are like sovereigns. These aren't private companies, private banks, things of that nature. Gold is tier 1 capital.
Now, again, I'm not saying that the world wants all the treasuries and hates gold. I actually think it's largely the opposite. But this chart, I think, is very important to understand when you look at that.
He said largely the opposite. Yes, that's how it is. They want to hold treasuries. Even China wants to hold treasuries because it's liquid. It gives them optionality. And they get a return. You know, you don't get a return on the gold. You have much lower optionality, liquidity for gold. They want to hold treasuries. But they view risk. Their risk profile is driving them towards gold, which is not good. That means that people see so much risk in the near medium term, that they are still buying it, even though they would rather buy treasuries.
And here's the other thing. A lot of people, I don't know how this goes. A lot of people are going to say, well, here's Brent, bad talking gold again, using these charts to show why the world doesn't want gold. And he's trying to show why this is bearish for gold. It's actually the opposite. I would argue that the fact that gold is at $4,400 or $4,200 and the central banks haven't even been buying all that much of it is actually incredibly bullish for gold. Because if you think about it, it's the difference between the red line and the blue line that has driven gold prices higher. If people really start, or if central banks really start to buy gold, it's going a lot higher than $4,400. So this is not me saying central banks are not buying gold. This is not me pointing this out in order to be bearish gold. I actually think it's the opposite. It just shows you that gold is a relatively small market compared to a lot of the others. And if those markets start to get rejected in favor of gold, it could push gold a lot higher. The other thing I want to point out is a lot of times when people talk about gold, they always talk about it in relationship to the US dollar. And that makes sense. The dollar is the global reserve currency. But when you talk about gold and how it's going to be used to dethrone the United States and bring down the United States empire, I don't get the argument of how gold is going to do that when the United States has more gold than anybody. And I already know how this is going to go. People are going to say, it hasn't been audited since whenever. Okay, fair enough. It hasn't been audited. When was the last time you saw the Chinese audit? And when's the last time you asked for it? When's the last time you saw the Russian audit? And when's the last time? In other words, why do you automatically accept all the other numbers on this chart, but you question the US one?
Yep. And it gets worse. It gets even worse, Brent. Because they're communists. Okay. They're liars. They will lie openly, keep information from the market. I mean, they keep information from their people. They have a great firewall of China. I saw a post today saying something about Elon or Starlink should open up direct to cell phone access to the internet. And the reaction was, no, this would cause a nuclear war. So their people can't even access the internet like the rest of the world. And we expect them to be honest about things, and we expect them to be so successful that they're stacking all this gold and then they're able to keep it quiet and yada, yada, yada. No, absolutely not. Absolutely not. If anything, I would say the U.S. is further ahead than these official numbers say. All right.
Now, I'm in favor of questioning them. And I think you guys have maybe heard me say before, I actually think the U.S. has more gold than they say they have. I think China has more gold than they say they have. But the point is I don't, if the world were to go back to some kind of a gold-based system, I don't think that singularly hurts the United States. And I think if that were to happen, the United States could be right there involved in using gold in the same way that the other countries use gold. So
No, it doesn't hurt the United States. It actually benefits the United States. You know, the rest of the world, especially you hear all this stuff talk about the global South this, global South that. Well, the global South was raised out of poverty by global credit markets. And who is responsible for 90% of the global credit market? The United States. Yeah, very recently you've had China with their Belt and Road. They have other things like that, but it's all crumbling. But the Belt and Road is an utter disaster. You know, who would have thought that funding projects that other people have turned down for 50 years probably means that they were uneconomical to even make in the first place. But oh no, China's there with their money, and they're gonna show the West that they know how to invest and that what they can build. And then they build it, and it runs in the red constantly, costing the country whatever hundreds of millions of dollars to maintain this thing. It only makes a few $1 million, right? Like they were bad investments. They're non-performing loans. So most of the rest of the world, we can look at the Japanese miracle. Of course, the European miracle after World War II was funded with the Marshall Plan and other things. Okay, then you have the Japanese miracle that was due to access to American markets and American capital and stuff. And then the same thing with China. They really took off after getting into the WTO, which is an American-led institution, or created at least institution, and access to outside capital. So it's even worse than that. If we go back to a gold standard, a lot of these countries will be shown to be uneconomical. A lot of these businesses that were built up in China, India, all over Africa, these places, they'll find out that they cannot survive without cheap credit, without cheap and lasting credit markets. And it will benefit the United States even more. Dex Invictus back with us. What's up? All right, let's go.
I don't see how gold brings down the American empire. Start talking about gold here a little bit, because listen, this has been an incredible move in gold. And this is almost a 40-year chart, 45-year chart. And the reason I put this on here is I wanted to show, you guys know I always like to look at the stochastics and the RSI and all this kind of stuff. But, you know, gold is so far above this is a monthly chart. It's way above its moving averages on a monthly basis going back to the 80s. But gold is now overbought. It's more overbought than it was in early 2021 post-COVID. it's more overbought than it was in 2009 and in 2013 before it went into, a multi-year bear market. And it is as overbought as it was in 1980 when it then went into a subsequent several year bear market. Now, this is not me saying
it's more overbought than in 1980 and 79. You actually, on the monthly chart, you have to go back to 1973 to get as overbought as it is today on the monthly chart. So you have to go back 52 years.
That gold at this level means it's going into a multi-year bear market. I don't think that's the case, but I can't rule it out either. History says the last 2 times that gold made a move like this, it then pulled back and stayed down for a while. Now, again, before this gets put all over, Brent's calling for a multi-year bear market. That's not what I'm saying. I'm just saying this is typically how moves end, not typically how they begin. Now, there's a lot of people out there who think this is just getting started, and maybe it is. I would argue the people that think it's just getting started believe that we are now imminently in the end game. I don't think we're in the end game. I think this is still going to take several years to play out. But if this is the end game and the monetary system is about to come down, then yeah, gold is probably going higher. We're there yet. And so as I think about gold at 4250, I think about even if it's a 25% position in your portfolio, as the permanent portfolio suggests, that means that's where it was at the beginning of the year. At this point, it's probably over 30% or up like 35%. So if you are ever going to do any rebalancing in gold, this is the time you would do it. Now, I'm not telling everybody to go out and start their gold. That's
my second aha moment when I was first watching this video is, yeah, there's going to be some major rebalancing going on. Gold, I don't know about, I know it's deeper within the financial system and it's deeper in portfolios, but I think that the investment thesis around gold is not the same investment thesis around Bitcoin. So when Bitcoin doubles, the people that own Bitcoin are not necessarily going to rebalance. They could, especially if it's in some, algorithmic type hedge fund or something like that. But if it's bought by companies as a treasury asset, if it's bought in retirements, even self-directed retirement funds or whatever, that they are not going to be rebalancing because they expect Bitcoin should outperform, right? Now, gold is a different thesis. If you see gold going up 50%, you're going to rebalance that almost for sure. Now, when will they rebalance that? It's already October 20th. They haven't even started yet. So most likely they're not going to do it right now. They're going to wait till the end of the year. Okay. That people will price that in ahead of time. So if we know rebalancing is coming at the end of the year, when do people start pricing that in? Probably pretty soon. I mean, it honestly cannot go much higher than it is right now. It could go higher. Like Brent always qualifies things, and I'll qualify the same thing. It could continue going higher. It could reach 5,000. But it's very close in time to the end, whether that's a couple weeks or whatever, okay? Even another month. It's very close in time to the top. That's what the chart's telling us.
Not the point of this. In fact, if you don't need gold, you should go buy some. But the point is this is not the time to necessarily be adding if you already have it. And if you think of gold the way I do, as a protection of power, protection of lifestyle, and an overall wealth preserver, then this is the time to rebalance. If that's not the way you think of it, if you think of it as a way that you're going to get rich or really make your mark in the world or whatever it is, and you're willing to accept the risk that goes along with it, then that's a different way of thinking about gold than I think about gold. Now, let me just pull this up on a 5-year basis as well. Or no, this goes back to 2007 because I wanted to show the global financial crisis. Again, it just shows we are as overbought now as any time we have been since 2011 when it last peaked. And then this is over the last year. And again, it's as overbought as it's been all year. Now, the thing I point out is just because something is overbought doesn't mean it's going to fall, doesn't mean it's going to crash, and it doesn't mean you should go sell it. It just means that it's very, very high on a relative basis to where it has been. It can easily go higher. Again, back in the summer or back in the spring, it was around 2,800, 3,000, and it was overbought. It is now $1,000.
Right. But Brent, we don't see, like, if we go back to the monthly chart, which I'll just do here on my end. We'll go to the monthly. And make sure we have RSI up. And let's put it on a log scale so we can kind of see it better. Okay, so 92.82. Let's make sure this is at the right spot. It's even gone higher. So 92.82 is this line. Higher than here in 79, all the way back here to 73. Now, when you see these charts, okay, and you see RSI, he's like, I'm not saying it has to go down. I'm not saying this. I'm not saying that. But what happens? Do we see any periods in time that are like this, where it spikes up and it goes like this and it stays up for a long period? No, RSI does not behave like that. What does RSI do? RSI goes up and down. It's jagged. Okay, it spikes and it comes back down. This is what RSI does. Okay, so we can say, we can't say like where the exact top is gonna be. It could be in a couple weeks because this is a monthly chart. So a monthly candle has 4 weeks in it. It could go for another 2 weeks towards the end of the month. And then what happens? Then it tops. Maybe it ends October on a high, and then November it crashes or something like that. But we can say that because of the way RSI works, because of the way charts work, that we're close in time to a top. Hope that makes sense.
Higher. So it's not to say that it can't go higher. I'm pointing out where things are. Now, here's the chart that I'm so interested in. This is the price again, and you can see how this is going exponential, right? Again, if this is not the end game, then I would expect that line to come back down. Now, I don't think it's necessarily going to crash. You would expect that line to come back down, unless this is the end game, $1,000 because the whole world's going to end. But what I really find really interesting about this chart is because the U.S. government is shut down, this chart has not been updated. Now, typically, this is a short position versus gold. And typically, you can use it as a reverse indicator when one is the other is really low. Now, the question I have is, as the price of gold has gone higher, now this is like 3 weeks delayed because the government shut down. We don't have the updated number. I'm really curious where this commercial short position is now the biggest ever, or down here near the biggest ever, or if this big run up caused by commercials throwing in the towel, covering their shorts, and therefore that's going higher. And listen, I don't know the answer. I don't.
Yeah, I mean, a gamma squeeze. This could be a gamma squeeze on these hedge funds. I'm not an expert in that stuff, but Jeff Park on the show, we've read through some of his posts, and he has a good understanding of that. And yeah, this thing is real. If you don't expect, like gold, you don't expect gold to move very much, right? You expect it to be fairly steady, maybe match inflation or something like that. Well, so you have different calculations on your options hedging. And as the price starts going up faster, you get squeezed very quickly. And you get this gamma squeeze going up. So that could be what's happening here. It's a gamma squeeze. And Bitcoin will experience this as well. Let me go to these comments here. Spock. Spock, by the way, did you see that I had on Sam Callahan on Friday? He's of Orange BTC. It's the Brazilian Bitcoin treasury company. Okay, what are we at? 2245. Let's go back and find that chart you're asking about. This one. And you say the difference between the blue and the red curve is inflation, no? So let's see. The actual value of gold in excess reserves, and red is assuming no change in gold holdings. No, I don't think the difference there is inflation. It's that they have increased a slight amount, but not much. So the difference is what's not accounted for in the price change. The price change would have an inflationary component, yes. But I don't think that's represented on the chart as far as I can tell. You say the other day you saw organized crime are robbing iPhones in Europe and all over the world to bring back to China because Chinese want unblocked iPhones to use regular internet in China. Interesting. Crazy they made it and re-imported. Yep. I mean, that's probably big business, I would say. I would think that they could do that without having to like rob iPhones. They could probably do that just by like delivering a container to Vietnam and then picking that container up and sending it back into China. I don't know. They probably have some inspections on the importation, but you could smuggle that maybe. I don't know. Maybe it's better to do small batches at a time. Reed, you say to go from 20 trillion to 30 trillion requires a lot of capital. Still, I haven't heard any serious speculation about who generally is buying all this gold. It's got to be players with enough capital and possibly a means to transport it. What are your thoughts? I don't think people are really buying gold. I think it's like we were talking about here. Where were we? 22.45. Like we're talking about on this chart. It could just be a gamma squeeze. So these are options traders. They have options on futures contracts or something like that. And there's not a lot of gold changing hands at all. It's just a gamma squeeze. And this will eventually, it will hit a top, but it can go very far. Like in the next week, it could continue going for another 20% in the next couple of weeks. Just squeezing on this algorithmic options trading function, But yeah, I don't think that there's a lot of gold actually changing hands. I think it's and then what happens is somebody will run out of money. This is costing somebody a lot of money. Eventually someone will go broke and that will be the top. But yeah, I don't think it's actually people transporting it around the world or anything. Like we've seen these charts about gold stocks in China, and it's like a straight line up over the last year or something. But that's like the supply at the exchange, at the Shanghai Gold Exchange, and that could be people dumping gold. That could be people bringing gold to the exchange and selling it. I mean, that has to be part of it, right? Every transaction has to have a buyer and a seller. So somebody's selling that gold and somebody's buying the gold, but it could be because people are wanting to sell it, not necessarily buy it. So yeah, there's different forces, different dynamics going on in different markets around the world, but it doesn't necessarily mean that there's gold changing hands. It could be. One thing I thought going back to earlier, like late last year, earlier this year, there was some movement because of the tariffs, and there was a lot of importation of gold. If you remember, the Federal Reserve actually put out some numbers saying, hey, this is our import-export balance. But if you take out gold, this is the import-export balance because there was so much gold coming into the United States at that time. How much, I don't know. But it was it was billions of dollars worth of gold coming in. And so much so that it was skewing the charts that the Federal Reserve was putting out. So, Spock, you put, robbing iPhones. So paper gold, yeah, a lot of it is paper gold. I'm not saying that, just like Brent will put that disclaimer on there, I'll say that too, that it could be some people moving gold, but I think the vast majority of this is paper gold. It is paper gamma squeezing of gold. Okay, let's continue.
And therefore, that's why it's going higher. I don't know the answer. I don't know the answer. I think for the most part, this drive up, it feels to me like has been driven more by physical buying than the speculators on the COMEX buying futures. But again, I really, really cannot wait for this to be updated. I'm really curious which way.
See, I'm the opposite of that.
It's going. Now, oh, you know what I want to do? I'm gonna switch over here. Hold on, I'm gonna switch over. I'm just gonna pull up my screen. Bloomberg resistance anywhere, because it's just kind of gone straight up. So what I did, I just went back a couple years, tried to look for a couple different support areas. You could draw a line there. You could draw this one here. If we were to pull up the moving averages, just to kind of get an idea.
I saw a tweet the other day. Someone was saying, this is not a parabolic move in gold. And then I took a screenshot of his chart that he posted, and I put in a parabola into it. And I said, it's literally going parabolic. Gold bugs will defend this move, but it's not natural. It's going to come. Well, it is natural, but it's not like based off of the destruction of the dollar or dumping treasuries or anything like that.
This line there, the 50-day moving average is down around 36.80. Now, my guess is that over the next week or so, we're probably going to bounce around in this area. We've got a Fed meeting at the end of the month. My guess is that we're kind of either going to be a little higher or a little bit lower into the Fed meeting. And then at some point in the next couple of months, we're probably going to come back down, test 4,000 or maybe even the 50-day moving average. That is not necessarily bearish for gold. And I would actually say that would be healthy for gold, because if you continue going up in an the more something goes up exponentially, the harder the eventual pull down is going to be, because nothing goes up forever. I think that
if this is due to a gamma squeeze, we could see a massive, massive drawdown. 25% at least.
Probably sometime before the year is over. We're probably going to be back down in here. Maybe. But here's the thing. Even if it came back down and tested the 50-day moving average, that's still a fantastic return for the year. That would be a 35% return for the year. You do that kind of thing. If you don't, that's totally fine.
Okay, that was about it. So let me see if there's any more comments. Puddington, you're typing. I'll wait for your comment. Reed, you said, when and if gold pops, do I expect folks to rotate into Bitcoin? I'm rotating into Bitcoin a little bit. So from anecdotal, like he was saying there, rebalancing, when I first listened to this, I was like, man, I guess I was just subconsciously rebalancing because, guys, I've been telling you that I've been selling my gold as we've gone up here. And, I've been a gold bug way long time before Bitcoin, but I'm a hodler at heart. So I held that gold the whole time. And now I've been selling it on the way up. People are rebalancing. I'm rebalancing, and I'm using some of that to buy Bitcoin now. And so I think there will be some of that effect. But I don't think that'll be the main reason why Bitcoin goes up. I think Bitcoin is going to be going up for the same reasons that gold, kind of the impetus around gold's move. So like I've said for many years, I was positive on Bitcoin, positive on gold for the same reasons that I'm positive on Bitcoin. Bitcoin should go up much more. If gold is going up this much, Bitcoin will probably outpace that when it's its turn to go up. Bullish on stocks. And let's take a look at the stock market here real quick. Make sure I'm sharing the tab. S&P 500 had a really good day. I'll go down to candles and we'll go to daily. So you can see I drew this on Friday. We did pop out above here on this kind of triangle that we were looking at. So yeah, positive stocks. Bearish on oil has been my call, which has come about too. And so oil, another down day for oil and US 10-year. And bearish on yields, bullish on bonds. And that has, I mean, it was rough riding out this period over here when we were going up. I was bearish on or bullish on bonds even during this period. But overall, I think if you zoom out and you look at like this monthly, a lot of people kind of see, can I fit it in here? What are we on? Logarithmic. So a lot of people see the US 10-year and they see that this is a break. Okay, so they see this trend down, and that this is a break of the trend. Let me see if that's coming through. Right? They see this as a break of the trend. But that's not what I see. Okay. We pretty much hit zero, very, very close. I think it's going to continue to come back down because of the deflationary nature. So this is not a break of the trend, and I think a lot of people probably got off sides here. A whole crap load of people are going to have this duration risk the wrong way. So yeah, this is going to come back down. It could come down fast. It could come down slow. It could bounce down, come down halfway, then go back up and then come back down the whole way, something like that. But overall, over the next several years, 5 years, it's going to come back down. It's just going to resume this because nothing has changed. Nothing has changed overall in the market. We still have a credit-based system that's based off credit. We're going to have a stronger dollar, lower yields. Nothing has changed. So the question was, do I see rotation into Bitcoin from gold? Not necessarily from gold, but I do think Bitcoin is going to have its turn here really soon. Let's take a look again here at this. So these are monthly candles. You can see they fit very nicely into this rising channel. Unlike any other period in Bitcoin history, you could put a channel around this, and we've talked about this before, but it's a very tight channel. That's a much more narrow channel, and it doesn't last very long. It lasts from July. It lasts for less than 2 years. And now we're going on finishing let's see, this was start in January 23, let's say. So we're going on 2.5 years now in this channel. It's a little bit wider. We have some stair steps going on, more measured, lower volatility. So this is a unique period in Bitcoin history. But what happened right after this first one? That was the major 2017 bubble. Now, will we get something like that this time? Probably not that strong. But, I wouldn't be surprised if over the next 2 years, we are pushing 500. That's possible. Especially if we get to 200 by the end of this year. So, and gold, has gone so far. Bitcoin is going to have its turn too. All right. Puddington. You say, I'm sure I saw a chart either here or on Twitter showing a massive increase in gold into China in the last few years. I'm not sure what it means, but it gave me the visual representation the Chinese bank was buying. Perhaps it was imports in general. I don't know, but the hockey stick chart, you might be talking about what I just mentioned a few minutes ago, and that was the stock of gold at the Shanghai Exchange. That was I think Andreas Steno put that out, but I'm not sure. And yeah, it was just took off in like 2024. It does not represent gold into China. If it's the same chart that I'm thinking of, it represents gold on the exchange. Read, I tried to short silver in my 401k, but my company's policy went. Oh man, yeah, I bet they do have a lot of restrictions like that. Silver. Okay, let's take a quick look at silver, and then we'll be done for the day. $52. This is a monthly chart. I remember I've been saying for a while, like I was saying back here, make sure that's coming through. I was saying back here, if it ever gets to 50 again, I'm going to sell. I cannot wait to dump my silver at 50. I dumped most of it at 50. I still have some, but I've sold a lot more of my silver than I have my gold, and I had a lot more silver than gold, like in ounces, obviously. But it's a new all-time high. I think it has the same, it's benefiting from gold's move, but I do believe that silver is more demonetized than gold is. I think gold still has this monetization bid. It has this monetary premium where silver does not, and it will not. I don't think it's coming back at all. You could say something like copper might have a meager amount of monetary bid to it. And yeah, it's high, but it's not like going parabolic like the other monetary metals. Silver is more industrial. It has been demonetized by gold and by Bitcoin now. So I think Bitcoin's larger than silver's market cap even now, with silver at 50, if I'm not mistaken. It had passed it, but silver might have overtaken it again since it has gone parabolic. Much less bullish on silver. I would be, I mean, yeah, you can hold shorts for a long time, especially if you are in some sort of synthetic short through an ETF or something like that. But it's really, it's not, I don't think it's very good risk management to short a parabolic move like this. So like I said, gold could go to 5,000. Silver could go to 75. It's possible. Is it likely? No, but it could. You could get a wick all the way to 100 on silver and be wrecked. So I would not try to like short the top. I would wait for some divergence. So, and this is not financial advice, even though it kind of is, but it's not. It could shoot up like this, come down, maybe make a marginally higher high. Okay, so that would be a divergence that I would want to, it would be much safer to short here on the way down after the second, especially, if RSI does not make a higher high. So that would be a bearish divergence. So it would come down like this, and then, okay, so this high here is with a lower high down there, right? And this is a monthly time frame. You could do it on weekly, but I would not try to short something that's going parabolic. That's not a good move, in my opinion. Just opinion. All right. So if you guys haven't, make sure you check out Rogue Macro. That's the new Substack where I'm going to be putting all my non-Bitcoin stuff over there, and Bitcoin stuff on to Bitcoin blog posts onto bitcoinandmarkets.com. But the Rogue tier, so the paid version of this Substack, is going to be the same as the paid version of Bitcoin and Markets. So that $15 tier is going to be the same for both of these. All right. That's it, guys. Thanks for hanging out, and I'll see you around on the next one. Bye.